All right, good morning, everyone. It is 8:40 in the morning of January 12th, 2023, and this is my pre-market strategy session. And so the CPI report came out about 10 minutes ago, and consumer prices fell 0.1% in December, in line with expectations from economists. Now, the year over year is still at 6.5%, and the consensus was expecting 6.3%. What is really the most important thing, though, is whether Wall Street believes that the Fed can engineer a soft landing or not. And by that, what the market is searching out is whether or not the Fed's rate hikes can match the CPI data, inflation data, so that both CPI and inflation sort of meet each other in the middle, and then inflation can start to drift down. So if the Fed, I think, is forecast to continue hiking until about 5 to 5.5%. So the overnight rate right now is 4.25%. So I think, in my opinion, that we can expect to see the Fed to remain hawkish, although not as hawkish, where they were hiking 75 basis points at a time. It looks as though they will begin to hike at perhaps 50 to 25 basis points at a time instead. So the trick here is going to be, the Fed is still hawkish, and the old saying goes, don't fight the Fed. But does less hawkish mean more bullish? I mean, does a rate hiking cycle the end of a rate hiking cycle being within sight, only roughly another 100 to 125 basis points away? Is that enough to sort of ease the tensions on the market? And there's a high likelihood of recession and so on and so on. But really, the economy can be in a recession, and the market can do something completely different if it's forecast that we recover. Suppose for a moment that we start recession in the second quarter, or say third quarter of this year. Does that recession last 6 months, and can the market look past it and say, okay, everything's going to be smooth sailing after we get on the other side of this thing? So my short-term bias is bullish. I am, we put in at least a temporary bottom here. You can see on the Qs right at this Fibonacci level. Let me get rid of these two trend lines here. And then if you just kind of look at the price chart with respect to the Fibonacci's, here we are at this Fibonacci level. And there's definitely support here. You can see in the past, it climbed up above it, sort of hovered around that price, that the same price that we are now, roughly 260 on the Qs. And here we are present in the past 3 months or so, October, November, about 3 months. There have been 3 sort of little attempts here to break down below that 260 level on the Qs, and it's held. And so now we're turning up for a third time. A big indicator will be if we break up above this. I'm going to call this the closing high, even though there's another higher right here. It's not a closing high. So this closing high at 293. I mean, there's nothing really stopping the market. I mean, nothing moves up in a straight line. However, it would not surprise me to see something like this occur, especially during January and February, which are traditionally bullish months, because those are the months that there are a lot of people doing some buying for tax purposes, a lot of repositioning by portfolio managers and hedge fund managers for the year to meet their benchmarks and so on. And so really, it can be bullish. So that's kind of my outlook. If we open up higher today, what I'd expect to see is, let me go ahead and put this line on there. Let's look at the 10-minute here real quick. So it went all the way into oversold. It touched off of oversold on the 10-minute in the Qs and went all the way into oversold on the 1-minute in the Qs pre-market. And so, the number was it 277.66 is the previous day's close. And so if I expect, I mean, this is my bias, however, I will trade if we start below 277.66, we rise above, find support and continue higher. I will buy the break of that sort of morning high right there. Even if we say, suppose we opened up right now, right here at 277.42, it would be strange if it did that. There's another 45 minutes of pre-market activity left. Even if we go up above, dip down way below, and then break past the previous day's high, I'll still look for a long trade right there. And so my short-term bias is bullish. There's another leg down coming for us, so we no doubt about it, because of this yield curve inversion, the 10-2 yield curve inversion. It can remain inverted for anywhere between 12 to 18 months. And here we are in month number 7 of this yield curve inversion. Let's see, you've got July, August, September, October, November, December, and January. And when this yield curve normalizes again, that's when we'll see another leg down on the Qs. And so for right now, outside of there being an inverted yield curve, there's really, not much else to worry about out there. I mean, the Fed is raising rates, but you've only got about another point to, I'll say point to a point and a half. And then if CPI comes down to meet where the Fed funds rate is, so right now the CPI is at 6.5%. And if the Fed raises to say 5 to 5.5 points, but CPI comes down within that range, comes down to 6.5, down to 5.5 or 5, then the Fed is getting a handle on inflation, and they'll probably start to just kind of ease off or not hike anymore, just be neutral, and watch what happens with CPI, with inflation, after they just kind of normalize the curve, or after they match their Fed funds rate with the CPI rate, and then watch for CPI to start coming back down to say, 2.5%. And then if, right now 4.25 is actually a normal Fed funds rate. 4.25 to 5, even 6 and 7 really isn't all that unusual. So there are, I think the most traumatic part of this bear market is over with for the time being. There will be, like I said, another leg down when that yield curve normalizes again. However, I just it would be strange, in my opinion, having done this for a while now, it would be strange to crash from lows right now. There's a recession coming. There is, and then there will be a downturn. There'll be a market reaction from that after this yield curve starts to normalize. But until then, it can be bullish. And for the time being, there's no reason to not be bullish. There's every reason to be bullish. So I'll be watching the open closely today, and I'll wait probably for about an hour until the open decides to do what it wants to do. There's kind of just a lot of open. Whenever you trade the open, you get these big, sort of patterns in the open that usually lasts for anywhere between half an hour to an hour. And then after that, I'll be looking for what kind of move it puts in. My bias is bullish. That doesn't mean I can't trade contrarian to my bias and be bearish if this thing really starts to reach for the pre-market lows to kind of break down. So I mean, anything's possible, and it always happens. Sort of when you're least expecting it. So I'll be sitting tight in my seat today, probably all day, even into the afternoon, through lunch into the afternoon for today's moves. So then kind of checking around here, let's see, the VIX, nice, the VIX. To get a breakdown below this 1912 on the VIX would be a big deal. Actually, there's kind of a neat pattern happening here. The VIX is looking to, there's a down move in the VIX, a pause, down move in the VIX, another pause, down move in the VIX, another pause, down move in the VIX. Eventually, yeah, in the short term, I see, no reason for this thing not to break down into the mid-teens, possibly here over the next 6 weeks. And that will be very good for the bullish trade. So let's see what else. The dollar's breaking down, very nice. Dollar down, it puts less pressure on stocks. When the dollar goes up, there's more pressure on the stock. So things are looking pretty good right now for the bullish trade. All right, everybody, good luck out there. Keep your risk tight. Click like, share, subscribe, leave a comment, tap the bell. Thanks for tuning in, and I will see you at tomorrow morning's strategy session. I am out.